Recession fears are in the air again. And if you're wondering how to protect your investments or even grow your wealth during uncertain times, you are in the right place. Today, I am sharing 7 investing hacks to help you stay ahead of a bear market based on proven strategies and smart money principles. Whether you are a beginner or a seasoned investor, these strategies will help ride the storm and come out stronger. Let's dive in. Hey there, I'm Palani, a technologist turned investor and an early retiree. I share my experiences from 20 plus years of investing in US and India. Thank you for your comments and amazing response to last video titled 7 stocks to buy during market downturn. It reached to 1.2k views. Appreciate your love and support. Without further ado, let us jump right in. Number 1, don't panic sell. One of the worst things you can do in a recession or a bear market is panic selling. When the market drops, many investors sell out of fear, locking in losses and then miss out massive rebound. I want to share some data to show a bear market could be your friend. So first, let us understand what a bear market is. When the index falls below 20% from the peak, the market is said to be in bearish territory. Average investors tend to forget one important fact on how the market returns are amazing after every bear market. Let us look at the chart that shows how long a bear and bull market lasted every crash and returns during those times. You will be surprised to see in the chart that bear markets last for a short duration like a blip compared to subsequent bull markets. Looking back, market crashes since 1970, duration of bear market varied anywhere between 40 days during COVID to 2 years in some other time. Panic sell your stocks. You are going to lose a huge return or opportunity that comes immediately after the bear market. Fidelity study once found that some of their best performing accounts belong to people who forgot they had accounts, reinforcing the idea that inaction often outperforms reaction. Since I started investing in 2004, I have seen 2 major crises. Markets always come back roaring. Of course, recovery time could vary. You need to stay calm. Use recession as an opportunity to buy solid stocks at sale. Remember, bear markets are temporary, but panic decisions can permanently damage your wealth. If you are too worried about future drop in the market, mindfully shave off some gains from the stocks that are sitting on 200% or 300% gains, or recoup money tied to bad investments in the past couple of years. Number 2, focus on defensive sectors. First, let's talk about what defensive sectors are. These are industries that tend to perform better or at least stay steady when the economy slows down. Here, we are talking about consumer staples like Procter & Gamble, Philip Morris, Coca-Cola, Pepsi, healthcare companies like Johnson & Johnson, Pfizer, etc. and utilities like Duke, telecom services like Verizon, T-Mobile. People don't stop buying food, taking medicine or paying for electricity or internet during a recession or a bear market. Here is a snapshot of how the defensive sector performed in the last 4 bear markets against S&P 500. These kinds of stable, cash-generating, dividend-paying companies also help to minimize volatility in your portfolio against tech stocks like Meta, Amazon, Google, and Apple. Coming to number 3, keep some cash ready. Cash is king. Keep around 10 to 15% of the portfolio in cash to take advantage of opportunities during bear markets. Park this cash in high-yield money market funds so that it keeps generating at least 4% return. Again, don't panic or oversell during market downturn or recession. Many might say Warren Buffett sold a lot of stocks and sitting on a 300 billion cash pile. Buffett game is different. He has to sell existing positions in order to raise money for new opportunities. For most of you watching this video, you have another source of income from day job. Keep investing it regularly without trying to time the market. Recessions often bring great stocks at bargain prices. If you have cash on hand, you are ready to strike when others are fearful. Your money can buy more now and use that opportunity. Number 4, prioritize quality companies. Recessions or bear markets separate the strong from the weak, value from the hype. That's why you want to invest in high quality companies, businesses with strong balance sheets, low debt, healthy cash flow, strong leadership. In factor investing research, quality stocks that have high ROE, stable earnings, low debt, consistently show lower drawdowns and faster recoveries in bear markets. For example, here is performance of high shares USA Quality Factor ETF that holds profitable US companies that have low leverage, demonstrate consistent earnings over time against broader S&P 500 market during different market meltdowns. During tough times, these companies not only survive, they often gain market share because of weaker competitors fall behind. In this bucket, you can think about some solid cash generating, dividend paying companies. Focus on fundamentals, not on hype. Hack number 5. Keep a long-term perspective. Markets move in cycles. Bulls and bears come and go. But long-term investors tend to win. Looking at 150 years of market crashes, you can see the market always tends to go up in the long term. Recession is like a blip in the hindsight. Have this long-term focus, stay invested, and let time work in your favor. This brings us to number 6. Use DCA and DRIP. Trying to time the market perfectly is nearly impossible, even for the pros. That's where DCA or dollar cost averaging comes in. Dollar cost average by investing a fixed amount in selected stocks or ETFs every week, irrespective of what happens in the market, is a great strategy. This is a simple and powerful way to compound your wealth in the long term. Another icing on the cake is DRIP, Dividend Reinvestment Plan. DRIP on top of DCA is a way to compound your return tremendously. Once you turn on DRIP in the brokerage account, every time a dividend comes in, it is automatically reinvested into the same stock or ETF. Look at the power of DRIP in the chart. From January 2000 to June 2022, S&P 500 soared 700% based on total returns, which is including DRIP. This is almost 43% more than the price increase of just So when prices drop, your money buys more shares. When prices rise, you still build your position. Over time, DCA can help reduce the impact of volatility and keep your emotions in check, and DRIP can significantly improve your return. Number 7, reassess your risk tolerance. A recession is a reality check for many investors. Ask yourself, can you handle 20 to 30% drawdowns without panic? For example, the market was down 57% during financial crisis, 34% during COVID. Having seen these crises, I believe 3 things are key to be successful in the market in the long term. 1. Emotional strength to understand that market volatility is part of the game and staying calm. 2. Bear market is your friend and staying invested is critical for long-term success. 3rd, having a good mix of defensive stocks, dividend-paying stocks, bonds, and cash are essential to minimize portfolio volatility. Use this bear market as an opportunity to align your investments with your actual comfort or risk level. There you have it. Recessions or bear markets can be scary, but they also present huge opportunities for investors who are calm, strategic, and patient. Follow these 7 investing practices. You will not only protect your investments, you might even come out stronger. If you found this helpful, don't forget to like, subscribe and hit the bell icon so you don't miss future videos. Let me know in the comments what's your number one strategy to invest during a bear market. Thanks for watching and I will see you in the next one.